It was a tough day for the stock market with the S&P 500 and Dow Jones Industrial Average down over 1%, NASDAQ Composite down over 2%, and the Russell 2000, not to be outdone, was down 3% here today. So really ugly way to start this holiday shortened week in the United States. Felt a little bit like the Cardinals and the Cowboys. David and I have a little bit of a friendly rivalry here. As you can see, I'm a happy supporter of the Los Angeles Rams who came through for me last night. But the Cowboys, no such luck. That was a pretty sad state of affairs there with that final drive. And it kind of felt that way with the stock market here today as well, where we stumbled into the close and closed near the lows of the session here today. So we'll see what all that means for our posture, and then we'll kind of get into the trade application example for tonight's video, where I wanted to focus on a stock very much in interest from that gentleman in the blue suit behind me, but the way that we're planning to take advantage of this highly speculative trade is through a long call option that doesn't expire for another 2 years. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 18th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list. Remember, that list not only entitles you to receiving notification once these free YouTube videos are posted, but it also gives you a heads up at the bottom of the email which stocks are giving you overbought and oversold cluster signals within the S&P 500. So I imagine there's going to be a lot of oversold cluster signals in tonight's email. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got our heat map here for the S&P 500, and it was a bloody day. As you can see, hardly any patches of green out there whatsoever. We did have nice little green here in the lower right-hand corner with some of those energy companies. We had ExxonMobil, Chevron, and Conoco kind of leading the way in that group. We had a little smattering of green here in the industrials with stocks like Caterpillar, John Deere, Lockheed Martin. Then we had a little bit in the kind of diversified telecom area with Verizon and AT&T. Otherwise, it was pretty ugly out there. This is a bad day from a market breadth perspective. Remember, we had some recent sessions where the market ended somewhat poorly, but it was a lot of the mega caps that were down, and the rest of the market was actually holding up reasonably well. That was not the case today. Today was a sell-off day across the board. Of course, those of us here in the United States celebrated Martin Luther King Jr. Day yesterday, and so we have to remind ourselves that maybe this was a little bit of catch-up from what we missed yesterday. Market was not open here yesterday, and so if markets were down across the globe yesterday, while we were closed in the United States, we kind of had to catch up with some of that selling here to a degree today. So maybe a little bit of that plays into it as well. But as you can see, a lot of red there with our mega cap tech-oriented giants, your Alphabets, your Microsofts, your Apples, your Amazons, your Teslas. That's what really drives index action, it seems like, these days. And when they're down, it's going to be hard to make any headway, and that has been the case more times than not in the last few weeks. It's been more difficult trading. One bright spot, you did see Activision Blizzard, really bright green here up towards the top. That particular stock got a buyout offer from Microsoft, as a matter of fact. So perhaps a play into the metaverse there to a degree, but Activision Blizzard, one of the biggest video game manufacturers on the planet, of course being bought by Microsoft, one of the biggest video game console manufacturers with their Xbox division. So Activision did quite well today on that buyout news, and then their competitor there with EA Sports and Electronic Arts in general doing reasonably well, up to 0.6%, and then one of the smaller video game players, our Take-Two Interactive, was up about 1%. But Activision, clearly the biggest winner of the day in the S&P 500, up nearly 26%, but obviously a one-time benefit there as opposed to expecting that type of behavior fairly regularly going forward. Let's go ahead and take a look here. But also I should mention real quick, financials did poorly today. Remember, that was a little bit of a change of feel from what we had experienced in recent weeks. We've been in kind of a mode where oil companies and financials companies had been doing quite well. Today was one of those days where oil companies continued to do well, but financial companies really took a back seat. A number of them, including Goldman Sachs, reporting earnings here today and recently, and really has not impressed the market all that much. I did happen to see that BlackRock late last week did announce a 18% dividend increase. That's a stock we've bought multiple times over the years in my dividend classes along the way. So happy to see that. But even dividend increases are not enough to offset the kind of bearish tone that this market finds itself in here more recently. Even Berkshire Hathaway, which had been hitting all-time highs here as recently as late last week, even gave back a percent here today. So financials took a bit of a breather today, and that had been quite different than what we had been experiencing more recently. All right, let's go ahead and take another look at breadth through the Market Watch tab here on Thinkorswim using the Visualize tab. And I do have the S&P 500 pulled up here as well, so a slightly different way to look at it. Basically just wanted to highlight how overwhelming the sellers were today versus the buyers. Up here you'll get a sense of how many stocks were up, in other words, advancing, 57, and how many were declining, 446. So by my math, that works out to close to 90% down day, about 89% there to be specific. So a lot of selling here today. It was not just a mega cap story. It was not just a small cap story. It wasn't just a mid cap story. Pretty much everything across the board was sold off today, unless you had a unique circumstance like we see there with that really big green bar with Activision Blizzard that I mentioned before. Otherwise, if you lost money in the market today, welcome to the party. Join the club, right? All of us that have long portfolios, more likely than not, ended up losing money today, and that's just the way it goes. Not a whole lot of patches to hide out on overwhelming selling days like we see here today, which is why it's always important to have a little bit of balance in your portfolio there as well. And, you know, we try to do different bearish trade setups and things like that with you guys here in these videos over time to help you kind of shake the rust off to a degree and make you feel a little bit more comfortable on the other side of the coin, because, right, if somebody isn't buying stock, somebody on the other side must be selling them, and therefore there's opportunities to try to take advantage of that along the way. I know we had an opportunity here a couple weeks ago with that Charter Communications where I short sold that. We ended up making enough on that short sale trade where it offset the losses that I had to take on some of my long call leaps trades on StoneCo and Editas, which we liquidated both of those and took losses on them on the same day that we took profits on the Charter Communications trade, and the winnings from the one trade more than offset the losses on the other two. And that kind of ties into my discussion a little bit later on tonight, where we will be kind of dabbling within the long leap space once again. So I'll just have you put a pin in that for right now, but it is just a friendly reminder that at some point we will be in a prolonged bear market, and at that time you will want to know how to trade bearishly. And if you don't know how to do that, I would encourage you to join Market Scholars if you want to take your education to the next level. Out of the 4 different trading rooms that I teach, really only one of them gets into bearish trading, but David, with his 4 trading rooms, gets into a lot of bearish trading. And so you will be able to kind of hone your skills if that is what is in store, right? We don't know if it is, but you want to make sure you feel comfortable on both sides of the coin and feel like you are ready to take advantage of those opportunities when they do show up at your doorstep. All right, let's go ahead and come on over here to the charts now. I wanted to show you this. This is the NASDAQ composite here. We've been talking in recent weeks how the NASDAQ composite has turned into a laggard, not a leader. And remember, that is different than much of what we saw over the last couple of years. But 2022 has definitely had a different feel with it. The NASDAQ composite, as you can see at the end of last year, where you have this kind of gray dotted line here, is the year crossover. So, last week or so of December of last year, we were up here at around the 15,800 level, and we've already dropped over 1,000 points, 1,300 points or whatever it's been in just the last few weeks since basically the end of the year, or at least the final week of 2021. So it's been a pretty straight line down as well. As you can see, we kind of topped out here on December 27th right here. And you can kind of see this orange and red line that's kind of being drawn by the chart here. This happens to be our zigzag chart, chart 6H. For those of you that want to follow along with me at home, I'm using $comp here. All I've done in this case is change the default parameters from 1% to 5% because I wanted to highlight that we have gone down over 5% in this move. In fact, we're pretty close to 10%. But the other thing I wanted to point out is that you could get away with saying that we have a legitimate downtrend in place. Now, this is not obviously a bear market, but a bear market eventually does need to start somewhere, and eventually there will be lower highs and lower lows, and I think you can get away with making that claim right now on the NASDAQ Composite. We have a high right here back in mid-November. We have a lower high here at the end of December. We have a low here in mid-December, and wherever we end up finding our low in this current move, whether it's today or whether it needs a few more days on the downside, it will be a lower low than what we saw right here. So lower highs, lower lows. Our next kind of level that you're looking at on the chart would be back over here on the NASDAQ Composite from basically the first week of October. We were trading around, let's call it 14,200, 14,300, somewhere in that general vicinity. So we're not all that far away from that. And obviously, if that gets taken out, things will look even worse there. So remember, this was a index that had done really well in recent years. We saw this big 17 or nearly 18% move from mid-May just here to the beginning of September. And things felt really good with tech stocks at that time. Even felt pretty good on this move right here where we went up another 12% into the middle of November. But since that moment, things have just felt a little bit sketchier here. And remember, this market has been led by these big tech companies. We're talking about the NASDAQ Composite here, but remember, it's those same companies that are really leading the S&P 500 as well, your Apples and your Microsofts and those types of companies. So it is an important index these days without a doubt. Let's take a look also at chart 6D. Whenever we have more than a 1% move on the major indices, I like to take a look here at this chart, at least with the S&P 500. And you can see that we were down 1.8% today on the S&P 500, 1.84% to be precise. And with that being more than a 1% down move, you can see that this red candle here did cross through this blue line on the bottom. Remember, the blue line on the top would be a 1% positive move. So today we had a 1% negative move with that red line there. In fact, we were very close to having a 2% down day. In fact, within the last half an hour or so, we were down 2% on the S&P 500, but we finished a little bit off of the lows there. So just managed to avoid the 2% move lower. But that's a pretty aggressive day that we just experienced here, right? It's not the most aggressive, but it was in contention with what we experienced there on January 5th and back here on November 30th. And then this was one of the bigger ones in the last half of a year, was on November 26th. But it was one of those bigger sell-off days. And along the way, I know David's been doing a good job working with you guys on the concept that, we get these bigger up days after we've already kind of gone into a more bearish type of a move, right? The most aggressive up days in the market happen immediately after the biggest sell-off days. And like, for instance, back here in November, we had these ugly candles, but we also had a lot of these green bars here. But the problem is those green bars are showing up here after the move lower. So it's almost like a dead cat philosophy. And we kind of are feeling the same way here as we fast forward to where we're at right now. You'll also notice that the VIX went higher once again. We ended at around 23 on the VIX, which is basically the highest level since what we saw here the first week of December. So there is more nervousness in the market. That's what that is helping us identify. Remember, the VIX is basically calculating interest in put options mostly to gauge interest in protecting portfolios and also in speculating to the downside on certain names. And so anyway, the VIX is certainly giving us the impression that the stock market is becoming a little bit more concerned. I mean, we're not seeing, dramatic VIX, right? We're not up at 50, 60, 70, 80 like we do in major market meltdown moments, but you never know when that might come out of anywhere and start to creep into the system. And right now, we have seen a steady rise in that VIX here since the beginning of 2022. Let's go ahead and do our normal foregrid here now on our market forecast view. This is chart 4B for those of you that want to follow along at home. And as you can see, doesn't look too promising out there. I wish I had better news. Don't shoot the messenger, right? I'm just telling you what I see, and unfortunately what I see is more bearishness here. And remember, it's easy to spot that bearishness with this chart setup that all of you premium members have access to, because the background colors will change depending upon the posture of the market forecast technical indicator itself. And so not a surprise that we have a clean sweep for the bears here on all four of these charts. So let's get started up there near the top with the S&P 500 and see how things look. So, we've had 2 out of the last 3 sessions to the downside here. Of course, again, we didn't trade yesterday because of the holiday, but 2 of the last 3 trading sessions, we were down, and pretty substantially, right? We closed near the lows of today's session. We closed near the lows of this candle here on January 13th as well. And so the one up day that we had along the way, while somewhat, thankful to have, if you're bullish on the markets, you don't want to see day after day of selling. We have to keep that in context, and that's just not enough to overwhelm the bearish sentiment of the market right now. And you can see that with the more recent selling that we've had on the S&P 500. Remember, at this point, we topped out January 4th. We have not hit a new high since then. And at that point, the green line, of course, was still in the upper reversal zone there on the market forecast technical indicator. But basically, right around this time here on the 6th, we fell out of that upper reversal zone and have been largely trending lower along the way, with the exception of one day along the way. You had a kind of a pop higher there that took that green line up just ever so slightly. But otherwise, it's been pretty consistently falling at this point. In fact, take a look at where we have arrived on the S&P 500 all of a sudden. We are at 53 and falling. And remember, once we pass through the 50th percentile, that will then be considered strongly bearish, and this background color will change to that dark pink background. Right now it's still light pink. Also notice that we have the red moving average. This is a 30-day moving average for those of you that aren't as familiar with this setup. And that 30-day moving average is still rising. Price is now below it, which is why we have a yellow coloration to it. But at least there's one positive element of this chart that we can discuss, and that is that the average price over the last 30 days continues to rise. How long that will last is anybody's guess, but judging by what I see on this chart, I'm not sure how long I'm going to be holding my breath on that, because you're seeing some pretty destructive price action here more recently, and the more of these kind of big red candles that pop up on your radar, the greater the chances that the moving average will eventually have to roll over as well. The Dow Jones was down, but not quite as much as the S&P 500. It was down 1.51% here today. Remember, the Dow Jones has been our leader, if you can call it that. Now remember, that's always on a relative basis. There's always relative leaders and relative laggards. And in this market, as discussed here in recent weeks, the Dow Jones has at least had the slight benefit of having big blue chip companies within it. And therefore, when the market gets skittish, as it has been here recently, it usually runs away from the riskiest, or what it perceives to be the most speculative assets, and tries to kind of hunker down in, some of the bigger blue chip types of names that are out there. Some of you that follow me on Twitter might have seen here that just this afternoon, right when the market was closing, I had mentioned that there were only 3 industries that closed higher today. Entertainment, and that was largely due to what I'd mentioned before with Activision Blizzard buyout. You also had oil, gas, and consumable fuels industry that was up as a result of higher oil prices. And then you also did have diversified telecom higher here today with a little bit of strength in stocks like AT&T and Verizon. And so you can think of Verizon as being kind of the blue chip type of company that would be in the Dow Jones Industrial Average. Now you also have Caterpillar in there, and they were a little bit higher today. But on the flip side, you had weakness in stocks like Goldman and JP Morgan and those types of companies as well. So even for the blue chips, today was not a good day. It's just that there were maybe a few more patches of green within some of those blue chip areas than what you're going to find in purely speculative types of markets that are out there. So Dow Jones was down less than all of the rest of these indices today. Remains our, quote unquote leader, at least on a relative basis. You can see that its green line is at 66 right now. It is falling, so we do consider that weakly bearish. But you'll notice that the intermediate line on the S&P 500 is at 53 and falling, meaning that it is sold off harder in that its technical position looks weaker here currently than what we see with the Dow Jones. But without a doubt, none of these charts look great at this point. It's just that on a relative basis, Dow Jones is maybe a little bit better than some of the others. Let's talk about the 2 bottom charts here now, because those have been our problem children, and they have been for a long time. So this should not feel like new information to any of you who have been listening to us for the last several weeks. It has been the case that the NASDAQ Composite and the Russell 2000 have been sketchier here recently. Remember, they are perceived to be riskier. And when there's a risk-on mindset in the stock market, things can go really, really well with those areas. When there's a risk-off mindset like we have right now, then all bets are off. And those are the places that you're probably not going to gain a lot of traction unless you get kind of lucky with something like an Activision Blizzard or what have you. So when you look at these 2 bottom charts here, the NASDAQ Composite and the Russell 2000, both of them look terrible, right? And they have looked terrible. They've been trading mostly under their falling 30-day moving averages for months now, right? I can actually put an S at the end of that, because even with the NASDAQ Composite, it really started trading below its moving average here the first week of December. And with the exception of that kind of week right there at the end of 2021 where it managed to stay above its moving average, for the most part, the vast majority of days over the past 1 month plus have been below that falling moving average. Same thing goes with the Russell 2000. It's been consistently trading below that falling 30-day moving average. NASDAQ was down 2.6% today, a pretty ugly day. Again, closing near its lows, similar to the NASDAQ, or similar to the S&P 500. What I'd mentioned, where you had 2 out of the last 3 days closing near the lows. It's kind of the same picture down below here with the NASDAQ. And going back to what I mentioned briefly a moment ago, there's quite a bit of overlap in those 2 these days, because both of them are market cap weighted, and because the biggest companies on planet Earth have become Microsoft and Apple. Both of them are major components within both the S&P 500 and the NASDAQ Composite. So we're kind of in one of those moments in time where what's causing these charts to look the way that they are kind of the same thing all of a sudden. Whereas you don't necessarily have that with the Dow Jones. Remember, the Dow Jones is not market cap weighted. It is price weighted, which is also a kind of a goofy and peculiar way to go about things. But the point is, it's different than the S&P 500 and the NASDAQ Composite, which are market cap weighted and which do have an exaggerated emphasis on stocks like Apple and Microsoft. You're not quite to an oversold cluster signal there on the NASDAQ Composite, but you're getting awfully close. It would not be outside the realm of possibility of us getting an oversold cluster signal on the NASDAQ Composite within the next week or 2 if things shake out the right way there. So perhaps when that occurs, maybe there's an excuse to kind of go counter trend and be brave and go and take the other side of that trade and try to get some quick little points to the upside. But keep in mind what I always mention, which is when we get an oversold cluster signal, that's not typically the moment where you're thinking to yourself, okay, this is the moment where the downtrend stops and the uptrend starts. Typically, it's just telling you things have gotten too extreme in one direction. It needs to correct itself in the short term, but that prior trend is more likely than not to hold. So we're not there yet, but I just, in case that happens to happen on a day when I'm not with you on a Tuesday or a Thursday, just keep that in the back of your mind there. Russell 2000 looks pretty pathetic. It was looking a little bit better than the NASDAQ there for a little patch of time a week or two ago. But my mindset is shifting much more bearishly once again. It's not that it wasn't bearish before, but I was holding out some hope that maybe, just maybe, the Russell 2000 could get its act together because it has been an underperformer versus the mega caps for years. And it kind of gave you the impression that it wanted to. It was lingering around that 30-day moving average for a lot longer this time around, where it kind of gave you some, little rays of sunshine, some hope that maybe this was a bottom. Well, I think today decides that for us. It was not a bottom, right? We put in a new low today. Up until today, there was still that little hope that these, prior bottoms back here would hold. But after today, especially the way that we closed near the lows of the session, all bets are off. This is a continued downtrend that we are dealing with here on the Russell 2000. So it was down over 3% today, 3.06% to be exact. And as you can see on the charts, both the NASDAQ Composite and the Russell 2000 do have strongly bullish postures, not just weekly bullish postures like we see with the two charts up above. Let's take a look at the 3 green arrows status here. And I would imagine we're probably in 3 red arrows status more so than not, but let me just verify it. That's chart 4D for those of you following along at home. And indeed, that is the case. You can see here that we have a clean sweep. All 4 of these charts have what we refer to as 3 red arrows, meaning that there is bearish elements on those charts from the perspective of the 30-day moving average, the MACD histogram, and the stochastics. The bears are in control right now of all 3 of those technical indicators. And it doesn't mean that we're necessarily heading into a bear market per se, but it just means that the current conditions are more bearish than bullish. And so they're more precarious. You've got to be a little bit more cautious if you're a trader, right? If you're a long-term investor, you might be looking for opportunities out there, right? I taught my dividend growth investing class as an example here today, and we got the opportunity to look at a stock that we had not looked at in over 3 years. And the exact reason behind that was because that stock, like a lot of other companies, had sold off in the market here in the last few weeks. So, if you are a long-term investor, look for those opportunities that might not have been present for recent years, but the market temperature and mood is shifting here all of a sudden, and those kind of those secular growth names that were once very much in vogue in recent years have fallen out of favor, and some of them might just show up right in your lap, and who knows, some of them might end up being excellent opportunities moving forward. So again, if you're a premium member of Market Scholars, feel free to check out my recording today if you're curious about what that stock was. I taught my dividend growth investing class today. David taught his directional option strategies class here today. Tomorrow morning, I'll be back in action with my factor-based swing trading class. Remember, that is where we can do bearish trades if we want. And then David will be teaching his options inventory class tomorrow at 2 p.m. Eastern Time. Also, wanted to thank you all for helping support this presentation. Remember, anytime we're up and over 100 likes there on Twitter, I feel like it's worth my effort to do the longer version of the video, including a trade application example. So for those of you that like the long form video like this, keep up the great work of clicking like for me there on Twitter. And you guys have done a wonderful job, and I really, really appreciate that. For those of you that would prefer a shorter video, if you only want a 15-minute quick hitter type of a video where I only concentrate on the indices and not have a trade application idea, then don't click like on Twitter, because if there's less than 100, then we'll just plan on doing the shorter version the next time around. So again, if you want to support the video, that's the best way to do so. That's your way to say thank you to David and I for taking the time out of our day to do these videos. So again, appreciate the 111 of you that stepped up to do that for me when I did the video last time on Thursday. Also, the sector selector has been updated here. Remember, that's updated on Friday evenings. And so while we didn't have class yesterday as a result of the holiday, that's the top-down trend trading class that I typically teach on Monday mornings that we use the sector selector for, I did update it nonetheless on Friday just to make sure that the data was consistent and we weren't missing a week along the way. So let's kind of quickly review it here. And you can see that energy remained number one for the second straight week. We also had financials climb an additional slot. Now remember, that was before today. So it is possible that by the time I do the update on this upcoming Friday, financials might fall a slot or two because they struggled here today. But as of last week, they were still hanging in there pretty well. Consumer staples have been kind of just biding their time. They're retaining their strength that they had. Keep in mind that generally is not a great thing for the market's health in general. So consumer staples are usually where you go to hunker down when you're nervous about a lot of the more cyclical other areas that are out there. So it fell one spot from 2 to 3. And then materials made a move higher and real estate made a move higher. So materials may be benefiting from some of those inflationary pressures that have also benefited oil companies. Remember, they're both anti-US dollar plays to a degree there as well. So that might come into play with where their strength is. And, real estate, I'm not going to read too much into that because it was only a move of one there after falling 3 slots the week before, actually 4 slots the week before. So maybe just regaining a little bit of ground. Maybe they sold off a little bit too hard there. But otherwise, the bottom portion of the sector selector, all the rankings remained exactly the same with communication services remaining dead last there. All right, let's get back on track here now with some other charts, and let's do some 12 grid analysis starting with chart 5A. This is our asset class 12 grid. As these are popping up here, a reminder that these 12 grids will give you a sense as to whether the posture, according to the market forecast, is bullish or bearish. If the background colors are pink, that means that they are currently bearish market forecast postures. If they're green, it means that they're currently bullish market forecast intermediate postures. Now, when you're looking at this, you can see we've had a big move here recently in yields. In fact, so much so that we all of a sudden have an overbought cluster signal there on TNX. For a few days there last week, I was feeling pretty good about going counter trend on that. And then the last couple of days happened, not feeling quite as good there. Now keep in mind, we're not in the poorhouse yet on that trade on TLT, that trade application that I did because I sold the 139s. It's still trading at 140. So in other words, it's still above our sold strike there. But without a doubt, the chart's taken a turn for the worse there on TLT. You can see after stabilizing here for maybe a week and a half or so, the last 2 days have been really ugly. And of course, relaying the inverse relationship of yields themselves. Yields surged the last 2 days. Bond prices themselves fell. Now you'll notice that we're back to this green dot on the TLT. Remember, that was part of the motivation of doing that bull put spread. And it's also part of the reason I chose the spread, right? We talked about it at the time saying that we might be early trying to get into it here. It's possible, I kind of referred to the way that the TLT chart looked several months ago where you had kind of different groups of clusters. In fact, let me do this so we can just all see it together. I was kind of referencing this formation back here in October as well, where we had that first set of clusters here, which ultimately ended up being the left shoulder. Then there was eventually a head that formed with a second set of clusters. Eventually we had that right shoulder form where there was no set of clusters, and then that pattern broke out to the upside. And I said, be on the lookout for that possibility. I didn't know it at that time, but I just said, hey, since it happened before, it is certainly possible it could happen again. So who knows? Maybe that's what we're dealing with right now. Maybe this will ultimately end up being the left shoulder. Maybe what we're going through exactly right now will end up being the head, and maybe it'll stabilize after the second set of clusters here, eventually forming that right shoulder where markets go to the upside. I don't know if that's the case. Remember, that was part of the reason that I did the bull put spread itself. When you're selling, as I did that day, the 139 and buying the 137, you're effectively adding a hedge to your trade, right? That's why I didn't sell the 139s as a naked put like I would with individual stocks that I want to own at lower lower prices or what have you. I acknowledge that we were doing something a bit risky and a definitely counter trend, and it could most certainly not work out. For that reason, I wanted to kind of have a bit of a safer type of a trade application. So remember, if this continues to fall, we will lose money, but if it keeps falling below 137, we will not continue to lose more and more money with that particular trade application. I think it's a little bit too early for that. We've still got another, month or whatever it is, because those were the February contracts. Remember, this week is the January monthly expiration. We did the Februaries on that particular trade. So we'll see how things shake out in the next month or so, but without a doubt, we've seen some rolling over of bond prices here recently, so much so that we have yet again more oversold cluster signals there. In fact, they're not alone on U.S. Treasuries. You can see foreign bonds also have kind of their follow-up set of oversold cluster signals here today. Foreign bonds were down 0.49% and having an oversold cluster signal just like we were witnessing here after the first week of January. You can see that high yield bonds also struggled today. They don't have an oversold cluster signal, but it's somewhat noteworthy that they did sell off today. Remember, they tend to do a little bit better when oil prices are surging. Today, oil prices were surging, as you can see with the chart down below. That did not help high yield bonds. Today, they acted more like other bonds as opposed to proxies for junkier corporations who issue junk bonds, right? And that had not always been the case in the past. So a little bit of a change of tune there for high yield bonds. And remember, that's not a great sign for risk-taking appetite either. You can use high yield bonds as kind of your version of, the quote unquote riskiest bonds that are out there. And when the stock market is firing in all cylinders and people are willing to chase stocks higher, oftentimes, all else being equal, that's a more promising time for high yield bonds as well. So when high yield bonds start selling off, it's yet another reminder that this is a risk off market environment that we've found ourselves in here. I mentioned oil briefly, but just to put a ribbon on it, it was up 1.7% today to new multi-month highs there. And you can see that we continue to have strongly bullish posture on USO, or our proxy for oil in this case, and it is trading above a rising 30-day moving average. This has not been the smoothest of uptrends, right? There were people that got shook out of their oil positions here in December. In fact, in my Monday class, we were victims in a couple of those circumstances ourselves, only to see that trend rip right back higher there. So right now, we do see those oil investments, as I showed you a moment ago on the sector selector, as being the leaders of this market. And this just goes to show you why. Oil is at new multi-month highs here all of a sudden. Gold did not surge here today. Gold was actually down for its third straight day. However, it was not a big move. It was only 0.17%, and therefore, despite 3 days in a row of negative price activity, we still have a strongly bullish intermediate posture on gold, the same as we do with oil. Obviously, oil much stronger, but the point is gold is not like really falling out of favor and collapsing on the chart or anything like that. It's holding up reasonably well, as I mentioned, in recent weeks and months in this presentation. I think gold or GLD would have been an interesting iron condor candidate along the way because it has been so sideways of a chart, and that continues to be the case. U.S. dollar was kind of interesting in the last couple of days. Notice that the U.S. dollar, so I was with you last week on Thursday. It would have been on this day right here where I'd mentioned we got those oversold cluster signals. There's always that possibility of a reversion to the mean type of a move. That's been a big one for the dollar. Remember, the dollar does not move tremendously. So when you're looking at these percentages, you might, be bored to tears. You're going to be yawning when you're looking at a 0.63% move. But that is actually a huge day for this currency, right? The reserve currency of the world. Just happens to be against a basket of other currencies in this particular case. Nonetheless, it does go to show you how violent of a move this has been. That's a V-shaped type of a bottom right there after putting in those oversold cluster signals. So the last 2 days, we've closed near the highs of the session on the US dollar. I wouldn't necessarily say that that is a good thing, by the way. Again, another way to kind of judge risk appetite. When money is flowing into something like, the steady Eddie US dollar as opposed to going into something like, Twilio or Roku or, some other exciting tech-oriented company, then you'll know that the market is just kind of trying to batten down the hatches right now. So might be seeing part of that shake out right now. Interestingly enough, it didn't slow down oil. It did slow down gold. Gold has been down the last few days while the dollar has been up, but oil is kind of dancing to its own tune right now. So be on the lookout for a possible roll over to the downside on the dollar in coming sessions if you believe that 30-day moving average can act as resistance. Remember, right now, despite a very nice rally in the US dollar, we have seen continued strongly bearish intermediate postures. Okay. Also, I wanted to point out real quick up here on the emerging markets. They were down today 1.7%, but just note that we have a green background color on the chart telling us that we have a strongly bullish posture. So if I were to maximize that, you can kind of see the market forecast technical indicator down below then on EEM. And so we have sold off 3 days in a row here, but because we had gone up so much, we've been able to maintain that bullish posture. It's pretty precarious, right? You can see that the green line is at 80.2 and rising. So remember, if that were to fall down to 79.99, technically it would go to a weekly bearish posture. So if we have another down day tomorrow, that is entirely a possibility. But I do like the way that in the past, EEM had been trading in a pretty serious downtrend here, where you're clearly below that 30-day moving average. It even looked like that was going to be the case once again right here the first week of January. But we had a change of tune right here, where we had 4 out of 5 days to the upside, and we blasted up so much that we can withstand this what appears to be a pretty ugly 3-day pullback, but still maintain bullishness because we're still above that 30-day moving average here. Remember, the S&P 500 doesn't look this way, and EFA, the developed foreign stocks, does not look this way. So this is unique to emerging foreign stocks, and that will come into focus here when I get into my trade application example here at the end of the video tonight. Before we get there, let's take a quick look here at our sector 12 grid. So this will be chart 5C for those of you who are following along at home. As you can see, things have taken a turn for the worse from a sector's perspective. We only have 3 green charts left on the board. That's your financials on the top, your energy stocks on the right-hand side, and then consumer staples on the bottom. And remember, those were the top 3 on my sector selector as well. Remember, that doesn't always have to match up that way. My sector selector is based off of an equal weighted philosophy. This, what we're looking at here in front of us with the 12 grid, is a more traditional market cap weighting. But right now, market cap and equal weighting are basically suggesting the same thing, which is energy is our leader. Financials and staples are kind of vying in second and third place there. So today, we didn't really have much to cheer on within the market. The only sector that was up, so I talked about the 3 industries that were up previously, but the only sector that was up today was energy. It was up 0.4% today based upon those higher oil prices. And take a look at the crossover. The crossover, for those of you that can't see it, right here where I'm kind of circling with my mouse, is where the new year started. And as soon as the new year started, it was like a light switch. We were in a downtrend with oil. As soon as 2022 started and that calendar flipped over, we just have gone basically straight up on XLE. So what a remarkable ride for stocks like Chevron and Exxon and Devon and Pioneer and Diamondback and those EOG, those types of companies that we've talked about in some of my classes here in the past half of a year or so. They have just shot the lights out to the upside here so far in 2022. We'll see if it continues or not. Last week, things looked a lot better for financials. As I mentioned here today, they really got hit in the gut. Some of it as a result of Goldman Sachs and some of these others that were reporting earnings here more recently. But this is a pretty aggressive 3-day pullback here. The good news is they were up so aggressively, like energy was, that they can withstand a sharp 3-day pullback and still maintain their bullish posture. But remember, if XLF starts closing below this 30-day moving average here, all bets are off. I would imagine that the intermediate posture will fall below 80, and we will then end up with a weekly bearish intermediate posture. So we're not there yet, so we don't want to predict that because we hold out hope that there will be buying interest of financials at around that rising 30-day moving average there. And I would say the same thing with staples down below. Notice that staples basically pulled back here today and is now sitting gently above the rising 30-day moving average. That moving average has been colored green since going all the way back here to the first week of December. And if it were to fall a little bit more tomorrow, that would be the first day that would not be the case. Remember, if it were to fall below that moving average tomorrow, that moving average color will turn to yellow. So right now, I have no reason to believe that's going to happen. Generally, when I see a chart that looks like this, I give it the benefit of the doubt. And I say, if you're in an uptrend, we naturally understand that you need to have pullbacks along the way. It's just a matter of how aggressive are those pullbacks and are they breaking important support levels. And right now, this has been a reasonably aggressive pullback from its highs here at the beginning of the year, but we haven't really broken major support levels here. This chart still looks a lot better than most other sector charts that are out there. So I'm crossing my fingers here. Now, part of the reason I own a lot of consumer staples stocks myself, as you guys know, I'm a dividend growth investor, so it happens to be my largest sector. So just for my own benefit, I'm kind of hoping the staples catch a little bit of a bounce right here at the rising moving average. But if that's not in the cards, so be it, right? That's the type of thing when you're a long-term investor, you understand you're going to go through plenty of periods of underperformance and outperformance. The key is buying high-quality merchandise on the cheap and reinvesting your dividends along the way to make sure that your income stream continues to rise. So I won't be too heartbroken if it does fail this 30-day moving average here. But the point is, I think it stands a pretty decent chance of stabilizing around these areas and maintaining its leadership role currently within the market. All right, let's get into our trade application example here today. Now, this was a little bit of a different type of a trade application example. First of all, from a time perspective, those of you that are our premium members might have noticed that I actually did the trade and sent out the alerts earlier than normal this time around. I think you guys received the trade alert there on Telegram within the first half of an hour of trading here today. That's fairly rare. Typically, I wait towards the end of the day to do these market outlook trade videos, but I've been keeping my eye on BABA for a while. And I was teaching my class, my dividend growth investing class earlier this morning, so I figured I'll try to just put an order out there, hope to get filled, and didn't have to worry about me getting some sort of a whipsaw while I was teaching classes and couldn't do anything about it. So today was a little bit different from that perspective, where the trade was done really early. The other thing that was kind of interesting is that there were quite a few options contracts traded for that one. Now, what I ended up doing, as you can see down below here, I did a leaps call option, long call. This is a very speculative trade, so be very cautious around this one. I mentioned before that we washed the StoneCo and Editas ones out of the system because we had enough gains on our Charter Communications short sale to make up for those losses. So I kind of flushed those out of the system, and now I wanted to go out and hunt down some other stocks that have been getting blitzed here lately that could have a decent chance to rebound in the future. Now, of course, you can buy the stocks outright if you want to, but you can also buy calls. That's what I ended up doing in this case, and some of you might not be familiar with the fact that there's what's known as leaps calls that exist out there. And in this case, I'm going out 731 days. LEAPS is just an acronym, by the way, for long-term anticipation securities or something like note securities. Anyway, point is they're basically call options that have a lot of time on them, right? A lot of other options will expire in, let's say, the next 30 to 60 days or whatever. But a lot of times on the more popular companies out there, they do offer leaps as well, where you can go out a couple of years. So in this case, I'm actually dealing with January 2024 leaps, which is just over 2 years from this moment in time, which gives me a little bit more flexibility. Now, some of you might be saying, well, why are you doing the leaps here as opposed to just buying the stock outright? Part of it is the leverage aspect of it, right? This is a a trading presentation, this market outlook video. So if I did a whole bunch of long-term stock purchases, I would eventually run out of money. And so some of it is just from a functional perspective. I need to figure out ways to spend less money or do more active trades where I'm buying and selling and buying and selling. And so this particular presentation doesn't really set itself up for just the plain old buy a stock and hold it, right? Like I do in my dividend growth investing classes. So if I were to buy Alibaba outright, it would cost me, almost $13,000, right? Because this is $128.60 if I wanted to buy 100 shares. Instead, I can control 100 shares by buying a call option. And what I did was I bought this call option for $48.80. Now, the one that I'm doing is this one right here, the $100 strike in January 2024. Bought that for $48.80. And earlier this morning, it was actually trading there. You can see it ended the day at 53. So I was half tempted to just say, if I can get 53, I might as well get out of here and make a quick $400 on this. But of course, with this mindset being that I wanted it for the longer term to see how things shake out in the next couple of years, I decided not to do that. But it did work out very nicely in today's case that I did the trade so early in the day because Alibaba gap down to start the day. As you can see right here, I did the trade kind of in this initial opening half an hour of trading right here, where you had this big move lower to 124.82. And then shortly after that, it started rising. Now, it didn't close at the highs of the day, right? The highs of the day were back here about an hour and a half after the market opened. It kind of went higher and then kind of settled in as the rest of the day unfolded. But we still closed way higher than where the trade was done in the first half of an hour of trading here today. Part of what was kind of interesting about that to me is I had noticed that there were a lot of other people trading that. And that's really kind of strange. Remember, these LEAPS contracts, not a lot of people are trading these, right? Notice right here as an example, our volume. Very few people are trading out 731 days from right now, right? But this one kind of caught my eye. It ended up having 68 contracts by the time the day was done. But if you right click on that and then go to, I think is it more? Yeah, more info, and then go to this where it shows you the option contract itself, and then go up to trade grid and then just hit the upper left grid there. What it'll do is it'll basically bring you to the bid-ask spread of that option contract specifically as opposed to the stock itself. And this is what I was referencing right here within the first half of an hour of trading. This was before I had sent out the telegram. So this wasn't like a bunch of you guys after receiving my telegram trading this. This actually happened just 5-10 minutes or whatever it was right before that time that I had sent it out. So it kind of caught my eye, like, why are all these people trading this, right? And the low that this traded to was 48.36. So we didn't get the low, but we got close to the low. So I'm happy with the pricing of that. And it does go to show you that sometimes you get lucky with your pricing on paper money, but this was an example where you actually would have gotten filled at those levels there. And quite a few contracts were trading. I think there were like, I don't know, half of the contracts that traded today were kind of right in that batch right there. So that was interesting as well. Hopefully meaning that somebody else out there is looking at this same situation. This is about the 75 delta on the strike there. And it makes the math easy. If we got filled at, 48.80 or whatever it was, and we're concentrating on the $100 call, then you just add those two numbers together to figure out what is your break even. What will be your responsibility as an investor in 2 years if this goes according to plan. So 100 plus $48.80 equals $148.80, right? So that would effectively be your break even. So you're controlling 100 shares of Alibaba for the next 2 years with a break even price of $148.80. Yet you only had to pay $4,800 out of your pocket for accessing that control. Going back to, again, comparing that to just buying 100 shares outright, that would cost you $13,000 here today, or approximately, a little under than that. But, around $13,000 to buy 100 shares of stock outright, or buy the long call leaps option for spending about $4,800. So it's a lot cheaper than the $13,000 that you would have. Now there's pros and cons to that as well, but the point is you're leveraging your money to a greater degree if you think that this trade is really going to work out. Obviously, if the trade does nothing and just goes sideways, that is a risk for you, because anytime you're buying calls, that is a low probability trade. Remember, time decay is working against those calls every day, which is why you'll oftentimes find me on the other side of the coin selling calls and selling puts, right? Being the seller, receiving credits up front, taking advantage of the time decay. Here I'm at the disadvantage of that time decay. When you're buying calls or puts, you are at the disadvantage because time is whittling away your premium day after day after day. And so you need an additional delta move, directional move, to offset the decay of that time. So it's definitely not for the faint of heart. We've had some that have worked out nicely over time, including, Starbucks. I remember we actually talked about that a little bit here in one of my other classes recently. Where we were able to roll that, 2 or 3 times along the way. And I remember Discover Financial, we did a really great long call leaps trade on that one in the teeth of the coronavirus dropout, and that one worked out really well. But others did not, right? StoneCo and Editas that I mentioned before did not work out at all. They were ugly losses there. So remember, this is not for the faint of heart. This is a speculative trade, and it should only be done if you believe that there's a big upside in the underlying security in question. Now, speaking of which, going back to the chart of Baba now itself, Alibaba, remember this is the big tech giant in China. They're mostly known for e-commerce. Think of them as kind of like an equivalent of Amazon here in the United States. But they have elements of financial as well, where they've kind of got an embedded PayPal or Square in there with their Alipay. And they've also got a cloud division similar to Amazon. So there's a lot of different things that drive them, but they are a huge, huge company, one of the largest companies on the planet, not only one of the biggest companies in China. Today, there was some rumors floating around that the United States wanted to look at their cloud computing unit to see if there was any way that the Chinese could steal, sensitive U.S. data if the U.S. companies were using the Alibaba cloud. And so that was what caused the gap down to start the day. And that was what opened up the opportunity to buy those long call leaps at the price that we did. But the market kind of came to its senses a little bit more, and after gapping lower, actually recovered a big chunk of those losses as the day moved on. Now, when I look at this long-term chart here, this is a 10-year chart that we're looking at. Remember, Alibaba actually only IPO'd back here in 2014, so this is not a full 10 years, but still gives you kind of a lifetime view of the chart itself. And this has been a stock that's kind of been on my radar off and on over the years, more so than not here in the last few months because of what we've heard with Charlie Munger being a investor in Alibaba. Of course, Charlie Munger being the right-hand man to Warren Buffett there at Berkshire Hathaway. Charlie Munger has had some success in China with the electric vehicle company BYD Motors as well. But Charlie has been kind of peculiar in that he's actually tripled down on Alibaba. And so he seems to not be concerned about the regulatory concerns that the rest of investing world seems to be obsessing over with this massive downtrend here in the last year and a half with Alibaba, where it's gone from 319 down here to as low as 108. That happened here in the end of November is when it got to its lowest point there more recently at 108. Notice that on that candle, this is a weekly bar here, but it had an oversold cluster signal on the weekly candle there, and you ended up bouncing a little bit into the end of the year, putting in a slightly higher low there the final week of December. And so far in 2022, Alibaba's actually been up. Remember, that's different than the tech stocks in the United States. If you look at Amazon and those types of U.S. tech companies, they are mostly down, and in some cases down significantly. So there's been a peculiar amount of relative strength that has shown up here in 2022 all of a sudden on Alibaba as well. So that's what made today the gap down kind of the catalyst for trying to strike while the iron was hot, because this thing was starting to make a move to the upside there. But you'll notice that where this was bottoming out here, was right across the top of where what resistance was for Alibaba back here in, let's see, it was September of 2016, and then again initially after it IPO'd there in 2014. So sometimes you have that concept of old resistance becoming new support, and we are now pushing up and off of that. Now we're still in a downward type of a trend line move here. So we have not broken out of that. So that's why I mentioned before, this is speculative. Looking for something that's been bombed out. We can see that it's been bombed out with all those oversold cluster signals on weekly candle chart. We can see that the company has some sort of a support level around that area. And it's a company that is still considered a quality company, right? There's a lot of companies that have been bombed out 50, 60, 70, 80% or more in some cases. But a lot of those are those Cathie Wood types of stocks that don't have any revenues. And if they do have revenues, they don't have any earnings. So they're kind of more speculative, disruptive, innovative companies that are future bets, but aren't actual businesses to a consistent degree here today. Alibaba does not represent that. Alibaba is a very, very powerful company, a very profitable company. You can see all of these blue icons down below here. You don't see any negative signs. I don't see a single negative sign here, meaning that every single quarter since they've IPO'd, they've been a profitable business, and usually very handsomely profitable. So as the stock's price has gone down and their earnings have largely maintained strength, what you've got is a compressed PE ratio and things like that as well, which makes it maybe a little bit more attractive for value-oriented investors. You can see here on the short-term chart also with this kind of higher low that we had on December 29th, which was higher than the low on December 3rd, both of those days having oversold cluster signals on daily candle charts. We got up and over that 30-day moving average for the first time since back here in the early winter, and we've maintained some strength above that moving average. Notice the moving average has transitioned from red to yellow to green. Now, this stock does have a lot of risk as a result of it operating within the framework of the Chinese Communist government. Technically, they're using the VIE structure in order to allow foreign investors to invest in Alibaba, but the Chinese government never formally actually said that was okay. They just kind of went ahead and did it. You guys have heard that they've kind of clamped down more recently on stocks like Didi and others, where that won't be the case as much going forward. But for a while, there was that opportunity, and a lot of those big Chinese tech companies took advantage of that, and Alibaba being one of the most successful examples of it. So point is, they didn't exactly get the formalized signing of the bottom line by the Communist Party when they did their IPO in the United States. And so there is a possibility, not saying it's a likelihood, but a possibility that China could eventually just say, we don't want any Chinese companies trading in the United States anymore. And so we're going to ask you all to move your shares to Hong Kong instead. So that's why the marketplace is a little more paranoid around this name. If it wasn't for the Chinese government, I wouldn't be surprised if this stock were trading 40% higher than where it is right now. And so it's kind of a bet on cooler heads prevailing. Some of you may agree with that. Some of you may not. Some of you might think that it's going to get worse before it gets better. And if that's the case, of course, you're going to want to avoid this particular trade like the plague. On the other hand, those of you that think things have gotten a little extreme in the relationship between China and the U.S. and things are going to start calming down now, then this is a quality business that has been priced at an extreme discount. And therefore, having a speculative trade to the upside with a long haul leaps could be an interesting way to try to take advantage of that. Okay, so that's what I had for you here this evening. Hope you enjoyed the presentation. If you did, I ask one simple favor out of you. Simply click like for me there on Twitter. And if you could do that, it goes a long way to let David and I know that you want us to continue to do these full-length videos. Again, if you prefer the 15-minute version, then don't click like on Twitter. But just remember, those would not come with a trade application example like Baba here either. So if you really learn from those trade application examples, you're going to want to do your best to click like for us there on Twitter. So thank you once again for checking out this video. I'll look forward to seeing all of you premium members tomorrow morning in my factor-based swing trading class, and then David should be back with you here on this Market Outlook video tomorrow night. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.